Hello everyone, welcome to the Mantri series of BFM. As you know, in Mantri series we are covering all the numericals, objective questions, case studies, all the repeated ones of all the subjects, not only BFM, all the subjects. I am covering BFM and ABM, others are covering others as such. So follow the complete series, share it with your friends, like this video, subscribe to the channel, click on the bell icon. Today we will be covering market risk. As you know, market risk is one of the important risks in the banking which cannot be controlled. Importantly, see, there are basically three risks: credit, market and ops. Credit and operations can be controlled by you, but market risk cannot be controlled by you. That is not in your hands. For example, now this war scene is going on everywhere. Russia, Ukraine, Iran, Israel, or something, some other thing might start. China might start something. So is it in your hands? It's not in your hands. So that's why market risk is not in your hands, and that is the only point why market risk is the most difficult risk. And your studies also, in BFM studies, they cover majority market risk. Credit and ops is covered, let's say 25%. 50% is market risk. So let's move on. What is the market risk? The risk of loss due to fluctuations in the market prices, such as interest rates, foreign exchange rates, stock prices. Means what? Read this first. Risk of loss due to fluctuations. See this, due to fluctuations. Okay? Due to fluctuations in the fluctuations. So let me hold on. Due to fluctuations. Okay. Fluctuations. Why do these fluctuations happen? Why do these fluctuations happen in the market? These fluctuations happen because the world condition changes, world situation changes. Means, for example, right now you see US, the new president has come in. So there are talks of de-dollarization going on. There are talks of wars going on. Somebody might invade somebody, like Israel is going on with the attacking the various countries. Attacking means, after all, that's a separate aspect. We can somebody can have a debate on it, but something is going on in that region. Similarly, you can see Russia and Ukraine war. Similarly, now if some China and Taiwan breaks up, then what? Means many things can happen, and all these things will lead to the changes in the world order and changes in the oil prices, dollar prices. Immediately your repo rate changes because the inflation changes. Okay, so fluctuations happen due to this. Market prices, such as interest rates. Interest rates means, interest rates mainly we consider, whenever we say interest rate, we actually consider repo rate, mainly in banking. I am just talking from the aspect of banking. We consider repo rates, then we consider this CRR. These are the two main elements which we always focus on in banking. So repo rates and exchange rates. What are exchange rates? See, this exchange rate over here means mainly dollar forex related to dollar. Now it can be dollars here. Exchange rate for each currency is different. Each currency is changing differently. If you check the UK pound, it has fallen a lot since so many, almost last 2-3 years in comparison to the dollar. If you check the Japanese yen, that has also fallen. So major currency in the world right now, which is considered as the universal currency as of now, that is basically the dollar. If dollar changes, everything changes. Okay. So exchange rates. Now exchange rate, somebody can argue, why only dollar, why only currency? I can consider it as a oil also, petrol. I can consider it as gold also. So anything, see here, depending on what, in which market you are in, it depends on that. Okay. So exchange rate and stock prices. Stock prices means obviously once the exchange rate changes and the interest rate changes, the stock prices will definitely change. They will be affected. Okay. Market risk can be managed by diversifying the investment portfolio. Diversifying means what? What do you mean by market risk can be controlled or managed? How do you manage the market risk? What is basically, see here, if you don't put all the onions in the same basket, this X words we have to remove it now. Onions, we have to be vegan now, right? So if you don't put all the onions in the same basket, then you are saved. If you put all the onions in the same basket, if one onion is gone, every onion is gone. Right? So that's why market risk can be managed by diversifying the investment portfolio. You need to diversify this in either stocks or bonds or T-bills, okay, or various other instruments. You can diversify it in gold also. Depending on your investment, now we have e-gold also. So depending on the investment strategies and the investment manager, you will diversify it. Okay. Liquidity risk is the offshoot of market risk. Offshoot means what? What is liquidity risk? Liquidity means how much cash am I having? In our daily life also we have this concept. Means what? Do I have the money to pay my upcoming EMI? Let's say today is what? 28th? Yeah. Let's say there is the EMI on 1st of February. Do I have the money, sufficient money to pay it? If not, then how will I arrange for it? Liquidity means having ample money to run the current working position. It's also as simple as working capital. Isn't it? So liquidity risk, the risk of not having enough cash or other liquid assets to meet the short-term obligations. Short-term, look at this, short-term obligations. Okay, short-term means next, coming up. EMI, I just gave you one example of EMI for your, at a personal level. You can have this in many things. Some company might be having the liquidity position or short cash crunch in terms of salaries, giving salaries. Anything. Some government can be having, or some company can be having the short position or a crunch for paying up the bonds which are maturing now. Anything. See here, cash crunch can happen anytime, and commonly, kindly understand, this liquidity risk is a common feature to all the banks. You name it, big bank, small bank, good bank, standard bank, NPA bank, every bank. All of them have this liquidity risk. All of them. They always face this liquidity. Every company faces the liquidity risk. Why? The reason is there is a rule. Okay? There is a rule which says that expenses expand and eat up the income available. Simple rule. Expenses expand and eat up the income available. So whatever your income be, you let yourself be the biggest bank in the world. JP Morgan, let it be you, let it be SBI. Every bank will have a cash crunch because their expansions or their visions are bigger than the money that they have. Same is with human being also, isn't it? Same thing happens to you and me also. So, the risk of not having enough cash or other liquid assets to meet the short-term obligations, liquidity risk can be managed by improving the cash flow management and monitoring market conditions. Cash flow management means I need to see to it that I don't only get long-term funds, I also get the short-term funds. That's why RBI, look at this RBI. RBI has put in a system called a bucket system to the bankings. Okay, bucket. What is this bucket? Bucket system. What is this bucket system? It starts from overnight. It says that you have to match your assets and liabilities from overnight to Importantly, 28 days. First 28 days are very important. After 28 days, it goes for 1 year. After 1 year, it goes for 5 years. So up to 5 years, RBI is very strict about it. You can go further also. You can match your assets and liabilities for 10 years, 20 years also. But RBI is very particular about 5 years and more particular about 28 days. So that is bucket system. Once you match this, see this, can be managed by improving the cash flow management. This cash flow management can be managed using this bucket system and monitoring the market conditions. What is going on in the market? So accordingly, your treasury, your fund management team should take the positions. Very simple. If the world is moving towards downside or the world markets are moving towards downside, you have to take accordingly the short position, so that you earn in that. If the world or the world markets are moving towards long, upside, then you have to take the long position, depending on what the world markets are or the market in which you operate are. Okay? The market risk, now these are the questions for you. See, I told you, theory, objective questions and numericals. So theory, I just explain you what is the meaning of this market risk and liquidity risk. Now we'll go on for some questions. The market risk arises on account of transactions reflected in. Means how do you get the market risk? Reflected in banking book and trading book. Banking book, trading book and off-balance sheet exposures. So market risk arises because of what? Banking book, trading book, banking and trading, C. D is banking, trading and off-balance sheet. Let me see. What do you answer? Let's see. I know maximum of you will answer, one answer I know, which you will answer. Let me see. Are you answering the same? What do you think? Generally, we have a habit of whenever we see that all the comprehensive answers are there, means all are included in some option. We try to answer that only. So here if you see D, banking book, trading book and off-balance sheet exposures, many of you will tend to answer that. Banking book, trading book and off-balance sheet, because it includes everything. Jo chahiye wo le lo. You take anything, I'll give you everything. Okay, so this, many of you will answer this, but this is wrong. This is not the answer. Banking book, trading book and off-balance sheet, that is not the answer. Why? Because see this, market risk means what? Unknown, the fear of unknown or the risk due to unknown. Okay. In banking book, whichever bond you purchase, you keep it till the lifetime of that bond, till the maturity. So the question of selling doesn't arise here. Market risk arises whenever you are selling something. Whenever you have to sell something. If you don't have to sell something, then no question of market risk. Means it's that example. See here, I'll give you a simple example. I am having two flats. One in which I am living. I am living in one flat. Okay, and second flat is the investment. I've just made one investment. And I am holding that flat. Okay, investment. Now you tell me the price of both the flats increases. Let's say I had purchased both of them for, let's say, 50 lakhs. Okay, at that time I had purchased 50 lakhs each. Okay, now the flat in which I am living has gone to, let's say, 1 CR. And the flat which I have made for investment purpose, let's say it's gone for 80 lakhs. Or you can call it anything, any number you can give. I'm just giving you a sample number. I can give you this 180 lakhs. Chalo, 180 lakhs. So now you tell me, will I sell this flat? The flat in which I am living, will I sell it? Do you think I'll sell this flat? Because wherever I am living, okay, I won't sell this flat because my family is there, my all relations are there over there. right? So this is known as banking book, which you are not going to sell. Banking. And this flat which you have purchased for trading, means buying, selling, profits. This is called as the trading book. Okay. So this is a trading book. Got it? So this is the meaning of banking and trading book. So that's why kindly understand, banking book is of no use for market risk. Even off balance sheet exposure, this is also of no use to you. Okay. Off balance sheet exposure is of no use to you in market risk. Because off balance sheet exposure means what? Contingent liabilities, the liabilities which are coming up in future. So the liabilities which are coming up in future, it means what? Bank guarantee, LC or any availization, where I have given my commitment. एक बार commitment कर दिया तो मैं खुद की भी नहीं सुनता. That logic, commitment. Okay. So this is nothing to do with trading, this market risk, because I know what the risk is coming up. This is of the unknown. Trading book is of the unknown. So answer is this, trading book. Kindly note, market risk arises on account of transactions reflected in trading book. Okay. Dash is the risk that the value of your investment will fall due to the market risk factors, which include equity risk, risk of stock market prices or volatility changing, interest rate risks, risk of interest rate fluctuations, currency risk, risk of currency fluctuations, and commodity risk, risk of fluctuations in commodity prices. So which is this risk which is all inclusive? It includes everything. Everything is included. Market, this equity risk, stock market is included. Interest rate risk means repo is included over here. Repo, this. Then next one is what? Currency, dollar is included over here. Then commodity means oil is included over here. So everything is included. Which is that risk which includes everything? Is it market, inflationary, reinvestment, or forex, foreign exchange? Simple one, isn't it? It is obviously market risk, isn't it? Because market risk is all inclusive. These all are inflationary risk, reinvestment risk, foreign exchange risk. These are the parts. Okay, foreign exchange risk is a part of market risk. Inflation risk is a part of market risk. Reinvestment risk is different. You can call it a part of market risk. What is reinvestment risk? Reinvestment risk means when let's say I am having a FD right now of at 10% for 2 years. So reinvestment risk means, will I be able to invest in the similar FD after 2 years at the same rate? If not, and if the next rate of FD will be lesser, let's say 7%, then 3% is my loss. That is my reinvestment risk. Okay. Inflationary means inflation will eat up your income available. Kindly note, inflation, what is the meaning of inflation? It eats up your income available. Whatever you earn, and if the inflation increases, then your income is of no use. That much amount your income decreases, isn't it? Clear? So the answer is market risk. Internationally, a committee approach to risk management is being adopted. Which committee deals with different types of market risks? Who deals with market risk? Different types. ALM, so we call it ALCO, we call it over here. Credit policy, liquidity policy, and credit liability management committee. Think. Various types of market risks. Here, there are 3 committees, kindly note. One is CRMC, ORMC, and ALCO. I had taken this earlier. Follow my yesterday's risk topic, risks in banking business. This already I have taken it. CRMC, ORMC, and ALCO. Okay, let me summarize it a bit. Okay, summary only. CRMC, ORMC, and ALCO. Okay, these are the 3 risks. Okay. These are the 3 risks. Okay. So these 3 risks, CRMC covers credit. ORMC covers ops. and ALCO covers ALM, this one. It covers a market risk. Actually, you can call it MRMC also, Market Risk Management Committee, but it's called as ALCO. Common name is given throughout the world, ALCO, so ALCO. Asset Liability Management Committee. Okay. So, ALM, Asset Liability Management Committee will handle the market risk. Always remember, ALCO committee's means goal is always two-sided. One, it has to look at short term also, and it has to look at long term also. It's like the bicycle. Whenever you ride a bicycle, you have to pedal also, so that you have to do the pedal so that you keep running, and you have to keep the direct handle also straight. Both the things have to be done simultaneously. Same logic is with ALM. ALM has to look at short term also short, and it has to look at long term also long. Okay? Both the things it has to look at, short term and long term. Got it? Credit policy means committee. Now see this. Credit policy committee can be called as CRMC also. Depending on bank to bank it changes, name changes. Here I can call it any name. Logic is what is the function it is doing, what is the role it is doing. So CRMC can be called as Credit Policy Committee. Also it can be called as this Liquidity Policy Committee. There is nothing called as like this. Means in the risk management framework, there is nothing called as Liquidity Policy Committee or Credit Liability Management Committee. There is nothing like this. Some bank is putting some name and forming a committee. It can be a separate individual bank level. Okay, that is there. But credit risk level or credit management level or risk management level, universally, there is nothing called as these two committees. Okay, CRMC, ORMC, ALCO, and at the top level there is RMCB, Risk Management Committee to board. Okay, so simply these are the committees. There is this asset credit liability. This credit liability, it's actually asset liability management. Okay, this is asset liability management committee. You can call it ALCO. That's already discussed about ALCO, isn't it? So nothing is like this credit liability management or liquidity policy. See, now importantly, remember one point. Banks can form the internal committees. See, if bank wants, bank can form a canteen committee. Who can stop them? These are the standard committees in the banking system. Now you can form yourself whichever committee you want, isn't it? So this was a total market risk schedule for you. Now before going, join the Adda 24/7 batches. I'll show you how to join. Always use the app. Download the app first, and in the app join it. Right now there is a GOAT offer going on. You are getting 81% discount. Okay, plus double validity on Mahapacks, plus 200 rupees Amazon voucher. All the batches you are getting 81% discount. See, go to Adda 24/7. See this increment Mahapack. Right now, look at this increment Mahapack. This increment Mahapack will give you the maximum benefit. It will give you ebooks as well as physical books, both of them. Plus 15 plus batches per subject. So all the batches which are shown over here, all the one single batches, all will be included in this Mahapack, plus others. So ebooks, mock tests, these mock tests and ebooks are to the level of chapter wise per chapter, and also full length. Full length is also there, like main paper. Double validity, 6 months, buy for 6, get it for 12. Buy for 12, get it for 24. And discount, look at this. Everything is plus plus. See, put the code Y432. Okay, look at this. 80% off plus 1% extra through the app. Download the app. You'll get 1% extra more. Okay, so don't miss this opportunity. Join this increment Mahapack.